Geoff, good morning. What a pleasure to speak with you
Good
today.
morning.
And Geoff,
Thank
the
you.
big talking point is when will the Fed, and if they do, how aggressively will they lift off? What is your own sense on what we're likely to hear from the FOMC minutes tonight, and whether or not they're going to give us any indication on whether or not the Fed is going to lift off come December?
I'm not particularly sure that you'll necessarily get the definitive answer from the minutes, but I think you've already heard from, in particular, Chairwoman Yellen that a rate hike looks very likely now in December. So I think the minutes would have to be very, very dovish to push the markets off that particular view. We certainly do think the Fed will go in December, and our house view is that they'll move 4 more times in 2016. But our feeling is certainly that it's going to be as important what the Fed says about future rate hikes as the rate hike itself when that comes in December, which, as I say, seems to be pretty likely now, frankly.
Geoff, if I look at the global environment, the risk clearly is still deflation. Global data points are still anemic. It's official that Japan is in recession and Europe is in a mess.
Yeah.
So what kind of environment do you think we could be staring at? I mean, growth is still a very, very precious commodity.
I would say I couldn't disagree with that at all. I think you have to believe that the risk to our Fed call for 2016, for example, is that they don't move as much as 4 rate hikes. I think the risk would be on that side, not on the other side. I agree, the Fed seems to be focusing on their own economy, in particular the drop in unemployment and this little bit of a sign that's coming through of wage inflation. But worldwide, you're absolutely right, growth is softer than we had all expected at this stage. Our view is that emerging markets are going to grow by no more than just over 4%, both this year and next year. And I don't think there's a risk of a global recession as such, but certainly the growth story is under challenge around the world, and the Fed would be raising rates into that. I think there's no question that's the situation we're in.
I just wanted to understand from you what the market reaction could be if we have a rate hike. Either it's 25 or less than that, but the commentary is not very hawkish. Do you think the market will take it in its stride and not get unduly bothered? Emerging markets, that is?
Absolutely. Absolutely. We would expect emerging markets to do well after an initial rate hike if the Fed is very dovish about where rates go from there. In fact, we wrote that up in a report prior to the September meeting, when, of course, there was a possibility the Fed would move. We strongly believe that emerging markets will do better in the next 12 months if the Fed raises rates somewhat and there's better growth than if rates are still at 0 in 12 months' time, because if that would be the case, that would mean growth would be very poor. So our feeling is modest, slow rate hikes, consistent in our view with the global economy doing okay, is going to be all right for emerging markets, frankly. I think that's probably what's going to happen in 2016.
So within the emerging market pack, Geoff, tell us, where does India stand? Because up until now, say about a fortnight back, we were in quite the sweet spot, considering commodity prices are on our side. But, off late, because of the second quarter earnings performance, the kind of pressure that we've seen on the currency because of the dollar strength, and of course, because of the political scenario as well now teaming out in India, there are a whole lot of question marks being raised about whether or not the ruling party is going to go on with the reform process or not. Tell us, what are your thoughts on how India lies amongst the pack of emerging market cards?
A lot of questions there. We still like India. We're overweight India within the emerging market portfolio. Certainly, some of the points that you mentioned, the politics, the earnings, and of course the rise in the dollar, are headwinds. Our view is that you have to judge this government on a full 5-year term. Clearly, the recent setback in Bihar in terms of the election result was a negative, seemingly a negative for the reform program. But we think this economy is growing strongly. We think it's going to grow in the 7 to 7.5% range over the next couple of years or so. That's going to be a standout performance within the emerging markets as China slows. I think there will be more reforms. It may not just be as quick and as decisive as the markets may have hoped. And meanwhile, although India is stuck in a, like so many other markets, stuck in a slow earnings growth environment. In fact, to be fair, the Indian numbers are still better than most emerging markets around the world. We think this is probably going to be sufficient, nevertheless, given the overall fundamentals, for India to still do relatively well in what is not going to be an easy environment for EM. It's going to be challenging because earnings growth is weak. But within that, we think India remains one of the best stories. The dollar's a wild card, no question. We do see further softness of a number of EM currencies against the dollar next year, and India could well be part of that to a certain extent, but we still think there's going to be ample room for the RBI to continue to cut interest rates. So if you've put all that together, India's in better shape, I think, in terms of emerging markets than most other markets around the world, and this is why we retain an overweight.
Yes, I'm so with you when you say that on paper India is the best story and relatively in a bad world it is the only good boy. But if I look at flows, and especially for flows in this calendar year, foreign flows have been dwindling. This is the worst FI flow year for Indian equities in last 5 or 6 years. So if the India pitch is such a loud pitch, what explains this stepmotherly treatment which foreigners are giving to India?
Well, I think first of all, apart from the concerns there were in India, particularly early in the year, that the market had got overbought and it got expensive, and you've had certain events during the year which have caused investors to be a little bit nervous, and this may well have triggered a softer year in terms of inflows overall. But this has been a pretty terrible year for emerging market equities. We're down about 14% on the year. In fact, we've seen record outflows from EM mutual funds this year, currently running at $62 billion, which is by far the highest absolute dollar number we've seen in recent years. And therefore, India continues to be a relatively attractive place in what has been a very difficult year. You could also turn, if I may say so, turn your question around the other way and argue that if this has been a tough year for EM and India has not attracted the foreign inflows that we've seen in the past, well, perhaps on better news next year and some sort of stabilization of markets generally and of the Indian market, some of those flows could start to return. So even in relative terms, I should say, I still strongly feel that India's not come out too badly this year because it's been a pretty terrible year for emerging markets generally.
So 2015 has been a flat year for Indian markets, and in dollar terms it's negative. Do you think 2016 and beyond could be a good year for India specifically, and can Indian markets give a double-digit return in next 12 to 18 months?
I think over the next 12 to 18 months, they probably can give a double-digit return. We're out on record already as saying that emerging markets next year will probably only have something like mid-single-digit gains in terms of the index, because we do expect there to be a slight improvement in corporate earnings growth, which is the big drag on markets overall, not just India. And if that's the case, India could well be, according to our view, something of an outperformer. But I still don't think the absolute gains will necessarily be enormous. For emerging markets to do well, we've got to get the start of the Fed out of the way. We've got to see a pickup in corporate earnings growth. Then you might get better gains in India. Although, if our call is right that you do see a bit of dollar strength against a number of emerging market currencies, some of that strength will be lost for the foreign investor with a slightly weaker rupee. But I really do want to emphasize the point that this is a difficult world for EM because the growth is weak, because the earnings growth is weak. But India does look very good against that background. Given the growth of the economy, we think there's going to be more reforms. And very importantly, we must continue to give India, I think, credit, so to speak, for a very, very good campaign by the RBI to reduce inflation expectations. And what that likely means is you're going to see further rate cuts. So 12 to 18 months, certainly, I would say double-digit gains are possible. 2016 as a whole is going to be a slow year once again, but we believe probably a marginally positive year for emerging markets.
But frankly, if there is no correction, maybe a an ancillary bull market might just continue. But Geoff Dennis, so good having you. Thank you so much for taking the time out and have a great conference.
Thank you. Thank you very much.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.